Hey, this is Kathy Iconis with QBO Chat, and today I wanted to walk you through tying a tax return to QBO or your beginning balances or any other of that terminology that you hear. So basically, what we're doing is if a company has filed a tax return, we want our books to match that tax return, the balances, the ending balances that the tax return has as of whenever they filed it. So this is an 1120S filed 2017. So that's a fiscal year end of 12/31/17, unless for some reason they have it listed here as a different year end. So what we're looking at is we're looking at the tax return, right? And the question always comes up to me is like, how do we tie this out to QuickBooks or match it up to QuickBooks? And it's important to note that there's several different types of tax returns. So I've done, my example here is an 1120S, which is a tax return for an S corporation. And so what you'll see are 1120S's, 1120, I think just plain, which is more just a corporation. Then 1040s are the individual tax returns. Those are the tax returns we file. But then if there's a small business that just like flows through to them, that will end up on a Schedule C for them. And they it just fills out what the revenue and everything is and in net income and pushes it over to the front pages of the 1040. But there's also partnership returns, nonprofit returns, and those sorts. So those returns, well, I know corporations and partnership returns, they're separate returns that you have to file under this company name. So it's not you individually, you're not attaching that company to your individual return in that instance. What happens is that we create this and then we generate an informational return, in this instance a K1, that gets attached to your individual return. But so here, we have this 1120S, and the thing about the corporation returns, these 1120s, and the partnership returns is that on the first page, we just go through income and your expenses, your deductions, right? And then we have some other information that you check off on the second page. Third page is all this stuff that goes over to that Schedule K, specific tax issues, blah, blah, blah. Fun stuff, right? I'm not in the tax world, so leave me out of that, right? The tax preparer will do all that. But then we come down to Schedule L, and this is the balance sheets per the books. So my point is on corporations and partnerships returns, you get the balance sheet. On Schedule C's that are attached to the 1040, you do not get a balance sheet. So if you are dealing with Schedule C's, you might want to see if the tax preparer has a balance sheet on file. I don't know if they really have to, but they might. And then you can use that information to tie it out. But you're going to have a harder time with a Schedule C of matching up the balance sheet if you don't have the balance sheet, right? All you can really do is the revenue and expenses then, because they'll list all of that out. So with this, on the balance sheet, it gives you your beginning of year balances and your end of year balances. And it is a very top level summary view of things. So let me give you, so this is my sample balance sheet over here, right? And we have this total bank accounts of 13,879. You can see over here on the tax return is 13,878 within a dollar. There's a lot of rounding on tax returns, so that's fine. We're good, right? So you see that on page 1, it's box F that I'm attaching to, but then I'll have to look back at that for a second. But page 4, which is what we're on, L1D is right there, right? And then it'll go through other assets and that sort of stuff. We have our computers and accumulated depreciation comes out to 0. So our total assets are 13,878. Come down here, we have a credit card amount of 961 that matches that. And then we have retained earnings. It's 12,917. For our total liabilities and equity is 13,878. But let's look at this a little bit further, because if we go to the next page, there's a reconciliation of your income per books with the income per loss or loss per return. So let me scroll over to the P&L. And we go up here on the P&L, and we're seeing how these all match out. So again, it's the same thing. So this is the first page of our 1120, and 168, 168. Page 1, line 19. Let's see which that one is. This is other deductions. So really what happens is that there's a statement that is attached to the tax return that explains what all of these other deductions are. And in this instance, anything that has page 1, line 19, then those all come up to be, the total of all of those is the 72,144, right? But when we come down the end of the day, our net income is 1952.16, but our net income on the return is negative 758. So it's close, but not the same, right? So that's why we come back to schedule the page 5. Let's go down to page 5. And we start off with what is the net income per the books. And then we include these adjustments. So there's things that obviously are not deductible, or different variances between tax and what we actually show in a tax return, on the P&L, the tax return and the P&L. So in this instance, like half of meals and entertainment is not included, so we have to adjust that out. I have long-term care on here, that's adjusted out. So those adjustments, so we go from 1953, make these adjustments to negative 991, which is what's going to tie back to that first page of the tax return. So this explains why there's a difference on your P&L. Now, when it comes back to the balance sheet, this M2 is explaining the difference between the equity retained earnings area of the balance sheet to what we're showing on the tax return. So if I come back over here, and it gives the flow through for the year. So we have the balance at the beginning of the tax year, 17,854, right? We have other additions, loss from page 1 of line 21, which is the 758. Other reductions, combined lines, and distributions other than dividend distributions. And what we come up to is that 12,917 right here. So it's explaining to us, how we got to that ending amount on here, which is a great, way to figure out, if you have any differences, it could be from these things. So that's how you actually go through and you tie out the information to the tax return. So it's great on an 1120 or a partnership return, which is I think it's a 1065. Sorry. Again, I don't do taxes, but we have the whole financial realm of, we have the P&L and we have the balance sheet on those returns. So we're able to match that up to QBO. So all you do, you're looking at these balances, see if they match out. If they don't, then we want to know which ones don't match. So it won't be just one account that doesn't match, because this is everything's, double entry and everything balances out. So it'll be at least 2 that don't match, and you'll have to figure out why, and does that matter going forward? And, do we just need to make an adjustment at the beginning of the new year to make it all match out, or an adjustment at the end of the year to make it all match out? And will that all work going forward? But that's how we're really matching up what's happening on the tax return to what happens in our financial statements, those ending balances or beginning balances, whatever we're trying to figure out. So, and remember, it's important that we want our equity area at the end of the day to match what's on the tax return. So again, Schedule C, we don't have that equity area because we don't have the balance sheet, but on these other returns, we do. And the equity or retained earnings in this instance is always flowing forward, right? It's a combination of all the activity that's happened on the balance sheet and all the activity that happened on the profit and loss in prior years. So it's always rolling forward. And if it's off for some reason, then that means something changed from when the tax preparer prepared the return. And they like to be able to know, like, here's our ending point. The ending point is the same as the beginning point for the next year, because that's the way accounting should work, right? Our ending, things shouldn't change after we reported a return. So we get that, and then we, can move forward and prepare that tax return for the next year. If they're off, then they have to do investigating as to why they're off. Their numbers are off from your numbers in prior years. And this is why we want to make sure they match up so that the tax preparers aren't having to spend a whole bunch of extra time and our clients' money to figure out what happened. Because that can be a hard thing to unravel in any system. So it's something, it's a headache, and we want to avoid that. So this is also why it's important for us to match out the balance sheet to the tax return. And that way, we're all on the same page going forward, and that would make everyone happy. So there's my quick overview of how to tie out the tax return to the balance sheet or to the financials in QBO. And I hope that helps you out with your bookkeeping going forward.